Welcome to my channel. I'm Scott, and if you want to catch my newest video, I post one every day. In this video, I am going to walk you through the process of valuing Vroom stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Vroom is a New York City-based used car retailer and e-commerce company where consumers buy, sell, and finance cars online. The company was founded in 2013 as Auto America. In 2014, Eli Wertman and Alan Block came on board to transform the company into a technology platform and rename it Vroom. The company has a refurbishment facility in Texas and was included on Forbes' list of hottest e-commerce startups. The company's current CEO used to be the CEO of Priceline.com. In 2015, it acquired Texas Direct Auto, a Houston-based company founded in 2002 that is now owned by Vroom but operates as a separate brand. Rather than functioning as a peer-to-peer marketplace, Vroom is an e-commerce service that handles the entire transaction with no haggling involved. The company offers financing from more than 12 banks, and they deliver cars directly to the customer all over the country. All the cars the company sells are reconditioned. They also provide a 7-day money-back guarantee and a 90-day warranty. Let's get started with the model. This is a mid-cap company, 6.7 billion market cap. They're trading at $52 a share, and they have 130 million shares outstanding. Let's look at the financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. So you can see the company has negative free cash flow every year. Net income is the profit and loss on the income statement. It's revenue minus expenses. They also have negative net income every year. Revenue is the sales for the company, and that's growing at a nice pace from 900 million to 1.3 billion. This is the company's income statement. The top line is the revenue, the sales. Below that is the cost of revenue. An example of cost of revenue is cost of labor. The difference between those two numbers is their gross profit, and they do have a positive gross profit every year. Below that is their operating expenses. Examples are marketing and insurance. Then below that is operating income. So the company does have negative operating income every year. Since they're still growing their business, they're still trying to hit profitability. Below that is the interest they pay in their debt. Then below that is other income and expenses. This is usually impairments or other non-operational gains and losses. Then pre-tax income, and they don't have much in taxes because they're not making much profit. And then their net income. So the company does have negative net income every year. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company loses from its operational business. Then you have capital expenditures, which are investments in property, plant, and equipment. Operating cash flow minus CapEx gives you your free cash flow. And that's the cash that's remaining to pay a dividend, to pay down debt, or grow your business. Since they have negative free cash flow, they need money from somewhere to run their business. They issued $145 million of capital stock in 2018, $220 million in 2019, and $1.3 billion in the trailing 12 months. They're not adding any debt, since the amount of debt they're issuing is similar to the amount of debt they're paying off. So they're funding the business with stock. When a company issues capital stock, it dilutes you, the current shareholder. The most important part of any business is their operating cash flow. If you cannot generate positive operating cash flow at some point, you don't have much of a business because you cannot rely on debt and equity financing to run your business in the long term. You could think of operating cash flow as net income converted to cash because net income is your accounting profit and loss. It's not actual cash. And the way you calculate operating cash flow, you start with net income and then you have to adjust for the non-cash items. They had $4.7 million of depreciation. That's a non-cash expense that brings down your net income, but it doesn't affect cash flow. They had $10 million in stock-based compensation and negative $74 million in changes in working capital. This is changes in accounts payable, accounts receivables, inventory, things like that. Even though the company reported a $180 million loss, they actually lost $220 million of cash flow. Let's look at their capital structure. They have negative equity. That means their liabilities are greater than their assets on their balance sheet. And they have $174 million of debt, but they have negative $44 million of net debt. That means they could pay off all the debt with their cash on their balance sheet and still have $44 million of cash left over. And their WACC is 13.5%. And that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year for that's $8.1 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $5.1 billion. We divide that by 130 million shares. And we get a calculated stock price of $39. They're trading at $52, so they're trading at a 31% premium. It's a sell according to the model. It's hard to estimate the future free cash flows of a company with negative free cash flow. In order to figure out their future estimates, I had to look at analyst expectations. I also look through their financials and I try to come up with some figures. Of course, anything can happen in the future, but I believe this is a fairly realistic expectation. The stock IPO'd last year and it's been up and down. It looks like it hasn't increased too much since its IPO. The company had a commercial in this most recent Super Bowl. The commercial made it appear that visiting a car dealership was similar to torture. Instead of going to a car dealer, you can pay Vroom $600 to have your car delivered to you. This stock has gone up 6% in the past 52 weeks. That's worse than the S&P 500, which went up 17%. And the 52-week low was 32, the high was 75. And the stock is trading above its 50-day and 200-day moving average. About 3 million shares are traded each day on this stock, and of the 130 million shares outstanding, 97 million are on float, 73% are held by institutions, over 8% of the shares on float are shorted. The biggest shareholder owns 15% of the stock, then T. Rowe Price owns 12%, then Bailey Gifford 7.5%, then BlackRock, then General Catalyst Group. If you invested $10,000 into this company when it IPO'd, you would have peaked at $14,000, but if you're still holding on, you're pretty much at where you started. Let's look at their financial ratios. The average PE in the market's 9, the median is 14. PE is stock price over earnings per share. To calculate earnings per share, that's net income over shares outstanding. They have negative net income, so they have negative PE. When a company has negative PE, you look to the price to sales ratio. Price to sales is stock price over sales per share. They're at 5.1. Investors are paying $5 for $1 revenue. Price to book is stock price over book value per share. They have a negative book value, so they have negative price to book. Interest coverage ratio is EBIT over interest expense. They have negative EBIT, so they have negative interest coverage ratio. ROE is net income over equity. They have negative net income and negative equity, so we can't look at the ROE. Current ratio is current assets over current liabilities. They can cover their current liabilities 1.8 times. To summarize, I have them trading at a 31% premium, but that does not mean the stock cannot go up. The stock is not based off of how well the company is doing financially. It's based off of supply and demand of the market. The market can push the price up to as high as it wants to go. On the flip side, the market can push the price as low as it wants to go. Investors are forward thinking. If they think this company has great growth potential, they will push the price higher. It's really hard to predict short-term movements with this stock, but in the long term, I think they should be okay, as long as they continue staying the leader in their category. They do seem to have a really interesting business model that works, since their revenue has been growing. I rank their free cash flows 1 out of 10, because they're always negative. I rank their revenue 6 out of 10. It's small, but it is growing, which is good. And I rank their ratios 3 out of 10. They're pretty weak overall. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.